a 3-year bond, but we go out in the open market at the end of the first year. We buy them, and basically we retire that debt early. Okay, so what's the first entry? Well, we need to record the interest expense for that year, right? No matter what, we've had the bonds for a year, so we've incurred the borrowing cost, the interest expense that year. 10% is our annual interest rate times $1 million. That's $1 million, right? 10% of 10 million is $1 million. Debit interest expense, credit cash. We need to pay that. We pay it out on December 31st because it's payable on December 31st. So you debit expense, credit the asset. Now, we early retire the debt. What's the transaction? Cash goes out. How much cash goes out? Always start with cash if you can, because cash is going to drive the rest of the transaction. What's the cash that goes out? $10.4 million is the amount we pay to retire the debt. Well, what was the bond when we recorded it? We only recorded a $10 million bond. All right, so that would have been a liability. Now we need to reduce the liability through a debit. Reduce the $10 million liability, that's $10 million debit, but we need to balance the journal entry, so there's $400,000 left. Well, that's the loss on the bonds, on the early retirement of the debt. It's going back to lesson 3 on the chart of accounts. Your gains and losses, that would go into a loss category. I don't know if that's a specific account, but it's peripheral to Roundbelly's business. They don't go out, borrow, and then extinguish debt all the time. This is not part of their primary business, so that's a gain and loss. It's down below in those peripheral activities. All right, so that's early retirement of debt. Getting back to one of the concepts, contingent liabilities, important concept. Guarantee you'll see a problem about this. Guarantee you need to know this. This little decision tree, we record a liability if okay, I'll walk you through the decision tree and then I'll tell you about when you record a liability. Alright, a contingent liability. Is it probable? If yes, you record a liability. If no, you disclose in the notes. Remember I said relevant information that investors and creditors would want to know? Alright, relevant information is definitely a contingent liability. If you're getting sued by somebody and potentially you're going to owe them $5 million, well, an investor or a creditor is going to want to know that. That's relevant information. Disclose in the notes. If it's probable, but you don't know the amount. Okay, contingent liability. Possible. If it's possible, you disclose in the notes. If it's remote, you don't do anything. All right. So, if it's probable and you know the amount, record a liability. If it's probable but you don't know the amount, disclose it in the notes. If it's possible, disclose it in the notes. If it's remote, don't do anything with it. Also, common financial ratios related to liabilities. Current ratio, you take your current assets divided by your current liabilities. The more assets you have, the better, right? And so the bigger that ratio, the better, because the larger the numerator, the bigger your ratio is going to be. So the larger current ratio is better. A ratio of 1 is kind of the lowest you want. Anything below 1 is bad, and anything above 1 is good. Times interest earned ratio, well, that just shows you how well you're doing on your borrowing costs. Are you making money off of what you're borrowing? So if that's a large ratio, then good, you're making money off of the amount you borrowed. Alright, I'm going to flip the cheat sheet and we'll go to the back and we're going to go through some bond problems. Ignore the bond part. That are concepts and definitions from lesson 12. We'll get to those later in lesson 12. But now I'm laughing when I'm saying bonds because typically you only see bonds in a finance class, right? So what do bonds have to do with accounting? Well, bonds have some unique accounting journal entries, so we're going to go through those. Now, another reason I'm laughing is kind of only if your professors are torturous or kind of sadistic, well, you have to do these, but I'm going to walk through them just in case you have to. Alright, so, issuing bonds at face value. Hopefully you've taken a finance class or you're going to take a finance class. This will make more sense once you go through finance and you actually do your discount premium calculations. I'm going to go through this pretty fast. The concepts, though, I mean, you can go through this lesson again and get the concepts. Actually, the mechanics are pretty straightforward, but the concept you may need to go back for a couple times. Alright, issuing bonds at face value. That means we issue it at $10 million and we get $10 million. Well, I'll walk you through the problem. Prepare the journal entry for January 1st, 2011 to record the following bond issued by Roundbelly. Par value, $10 million. Stated interest rate, 10%. Interest date, December 31st. Bond date, January 1st, 2011. Maturity date, December 31st, 2014. 3 years. All right. What's the entry on January 1st when we issue the bonds? Cash, we get the money, and liability, we owe it, right? So we get the cash, debit cash, increased cash. And now we have a liability, increased liability, debit cash, credit, bonds payable. Now, on December 31st, we owe interest, right? So comes along, how do we calculate interest? Well, it's the par value times the interest rate. 10 million times 10%, our annual interest is $1 million. Recorded interest expense, debit interest expense, we need to pay it out, so credit cash. Now, at maturity date, on December 31st, 2014, the final interest payment is made and the principal amount is repaid to the bondholders. Now, these are pretty straightforward. Same entry. Interest expense, $1 million. Debit expense, credit cash, $1 million. Now we repay the bonds, so we're going to decrease our liability, debit liability, and decrease the asset cash, credit cash. That's if we issue bonds at face amount. Guarantee if you have a bond problem on an exam or a homework, it's not going to be at face amount. So let's go to issuing bonds at a discount, and then after that we'll go to issuing bonds at a premium. All right, prepare the journal entry for January 1, 2011 to record the following bond issued by Roundbelly. Par value, $10 million. Issue price, 95.19634% of par value. Stated interest rate is 10%. Market interest rate is 12%. Interest date is December 31st. Bond date is January 1st, 2011. Maturity date, December 31st, 2014. Similar given set, except for we have a discount. On January 1st, 2011, the bonds are issued to the public. What's the following journal entry? Okay, here we go. We get less cash. We're issuing the bonds at a discount. We don't get as much cash as we thought. We're issuing $10 million worth of bonds, but we're not getting $10 million in cash. We're getting a fraction of that, albeit a large fraction, but we're not getting that full. We're getting 95.19634% of that $10 million. So we record the liability for $10 million. We record the cash that we received, the 95.19634. Now the difference we need to record as a discount. All right, that's a liability. That discount gets amortized. Remember when lesson 9 we went through tangible assets, and we talked about amortization, and it's similar to depreciation. Well, this bond discount we amortize similar to depreciation. We do it annually, and there's a table below where we calculate the reduction. And so I'll walk you through the second part to the problem. On December 31st, 2011, the first annual interest payment is due to the bondholders. Roundbelly makes the following entry. All right, remember, $10 million, 10%. The cash we're going to owe is $1 million, right? That's the cash out. Hit that entry, cash, credit cash, $1 million. Now we're going to get into this weird thing where, what's our interest expense? Well, the interest expense is actually the cash interest plus the discount that we've recognized, or the discount that we're amortizing. And now you're going to need an amortization table, right? Amortization tables, cross your fingers, are given. 9 times out of 10, you're going to be given an amortization table, and you're just going to need to know what to do with it. I've given you an amortization table. I've got an arrow showing you where you do it. Remember, if it's a discount, the amortization goes as a credit. If it's a premium, it goes as a debit. We'll get to the premium next. Okay, but the amortization table we're given, first year interest, cash of $1 million goes out. We reduce our discount. It was initially a debit, so we reduce it through a credit. And then our interest expense is the sum of those two numbers. Conceptually, maybe a little bit hard to understand. Mechanically, very simple. We're going to be given an interest table. We reduce our bond discount. It was initially a debit, so to reduce it, we use a credit. We use the credit of the discount amount. We're given an amortization table right there, and then the interest expense is just the sum of the cash and then the amortization discount, or the discount of the amortization. That's issuing bonds at a discount. Those are the journal entries. All right, flip that. Issuing bonds at a premium. The given set, prepare their entry for January 1st, 2011 to record the following bonds issued by Roundbelly. Par value, $10 million. Issue price, 105.15419% of par value. Stated interest rate, 10%. Market interest rate, 8%. Interest date, December 31st. Bond date, January 1st, 2011. Maturity date, December 31st, 2004. All right. On January 1, 2011, the bonds are issued to the public, and the following entry is made. Remember, the bond's payable. No matter what, we're going to owe $10 million. That's the bond. Credit that liability. Now, we issue them at a premium. We get more cash, right? And that cash is calculated by the issue price percent times our par value. That's the 10,515,419, and our total. And so we need to credit the difference because we receive more cash. We need to credit the difference as a bond premium or a premium on bond payable. Now that premium is also going to be amortized similar to the discount. Now we're given an amortization table. Thank God, 9 times out of 10 you're given it. Now let's move on to the next transaction. On December 31st, 2011, the first annual interest payment is due to the bondholders. Round Belly makes the following entry. Cash, no matter what, cash goes out at $1 million. 10 million times 10%, $1 million. Record that entry first. Credit cash. Now, what's the premium on the bonds? Go to your discount table. Year 1, what's the premium reduction? Throw that up and debit. Why debit? Because when we initially recorded the premium, it was a liability. How do we reduce that liability, or the credit? How do we reduce that credit? We reduce it with a debit. So to reduce the premium credit, we debit it. We take the amount from the amortization table. Now the difference between the cash and the premium is our interest expense. That simple. Mechanically, it makes sense. It's all there. Conceptually, you may need to go through it a few times. But by all means, watch this lesson as many times as you need. Now that's current and long-term liabilities and the bond discount, the bond transactions.